Hi everyone, this is Tim Melvin, and I want to take a couple minutes to talk to you about today's column on long shot investing, where we picked a couple of stocks trading below $10 that looked like they had the potential to pay off big over the next 3, 4, 5 years. I'm basically a dyed-in-the-wool deep value guy, and most of my portfolio is in safe and cheap stocks that trade below book value and have rock-solid balance sheets. But I do keep a portion available for what I call long shots and turnarounds. Now, if I was a much younger guy, say 25, 30 years old, just starting out in the markets, the percentage of my portfolio that was dedicated towards true long shots and turnarounds would be a lot higher. It would be at least half devoted to this style of investing. The math is just so compelling when you look at these stocks that have the long-term potential to double or triple as they execute a successful turnaround. Let's just take a typical portfolio that's all long shots and turnarounds, and you've done a good job of picking them using the criteria that I'll go over here in a minute. And over the, say, the next 3 years, half of the stocks in the portfolio win, and they do in fact double, and the other half, some go up, some go down, but as a package, you just kind of break even. Folks, that's a 16% annualized return on the portfolio, handily beating the long-term historical returns of the stock market. By the way, if it takes 5 years, you kind of match the historical returns of the stock market, and you end up making about 10% a year. So now, if you pick wisely and you have a little bit of luck on your side, and again, half your stocks are winners and the other half just kind of break even over several years. But of your winners, half of them double and half of them triple. Not entirely unrealistic, as you'll see. Now your returns are really something to talk about. If this happens in 5 years, you've earned about a 15% rate of return on your money. That's pretty good. If it happens in 3 years, the shorter end of that much ballyhooed 3 to 5 year market cycle, you're earning 25% a year on average on your overall portfolio, and that's a return that would make even the most successful hedge fund manager out there blush just a little bit. So how do we find these stocks? I could pretend it's rocket science and that we really put in a whole ton of effort, but here's how simple it is to find long shot and turnaround stocks that have the potential and ability to double and triple your money over that 3 to 5 year market cycle. What I do is I sit down with Value Line, and online they have a screener, and all I enter into the screen is I look for stocks that have the potential, according to the service, to have average annual returns of 20% or more over 3 to 5 years. They rank every stock in their 1,700 stock universe based on that criteria. So we get a package of these stocks, and I think there was 51 of them when I ran the screen earlier today. Obviously, I cherry-picked. Now I'm just going to read. I'm going to read what Value Line has to say. I'm going to read all the recent news on the stock. I'm going to read the 10Q. I'm going to read the 10K. I'm going to just try to understand this company. What I want to know is, does this business make sense? There's a lot of crazy businesses out there that might look like they can explode, but it's something of a coin flip. I want to know why this stock has gone down in value, what's driven it down into the single digits to the point where it has this type of rebound ability. More importantly, I want to know, why are things going to change? What's going to happen over the next 3 to 5 years to make this business and the stock price recover in a spectacular fashion? Now, if you just apply those criteria to the 3 stocks that I talked about in the articles today, if you take a look, Fuel Tech is in the air pollution control business. Now, the stock has missed some of the recent analyst expectations, and it's tumbled down, into around the $5 area. Now, folks, air pollution control is not going away, and this is a global company with over 900 units installed around the world. And if you look particularly to emerging markets like China and India, coal usage is part of their long-term energy policy. It's not going away anytime soon. This company's products are still going to be needed. There's new EPA regulations, and there will, I promise you, be more new EPA regulations that are also going to benefit this company here in the United States and throughout North America. So short term, there's some headwinds, not a lot of activity in the industry right now. They're just wrapping up a large project down in South America. But long term, spectacular things could happen for this company. This stock could easily double, triple, or more in value. More importantly, the balance sheet is clean. They don't owe a whole ton of money. They're going to be able to survive long enough to thrive in the future. Acco Brands, this is just an economy story. They make staplers and laminators and school supplies, and everybody's been cutting back. There's been consolidation in the office supply business, and that's probably going to hurt them a little bit in the short term, and they'll struggle to keep up with Wall Street's estimates. But as the economy recovers, people and businesses are going to start spending on electronics and computers and office supplies and all this stuff that they need. The company will see business get better. Now, pre-recession, this was a $25 stock. Now it's a $6 stock. If it just recovers part of the ground back, it's a double or triple over the next 3 to 5 years. If they go all the way back up to 25, then it's a four-bagger, and we're starting to have a pretty good time with this stock. Can easily double over time, though. It's a great long shot. They're building up their cash balances. They're paying down debt. So again, it looks like they have what it takes to survive long enough to thrive in the future. And the last one is a stock that I really, if you put a gun to my head and said, Tim, you can only own one stock for the rest of your life, any extra money you get, you got to buy shares of this stock. This one's on the short list for the finalist, okay? Apollo Investment is a business development company that specializes in middle market lending. They do direct lending, mezzanine financing, just lending to companies throughout the United States that maybe do not have that A-plus credit. They can't go to the liquid bond markets, so they're doing private direct lending. Now, they have a relationship with Apollo, the private equity company, and they're CEO Leon Black recently talked about some of the tremendous opportunities in the illiquid debt markets and the huge premiums that they were able to earn over the more liquid publicly traded debt markets. Interestingly, not too long after that, Henry Kravis and George Roberts made very similar comments in Barron's about the tremendous opportunities in middle market lending. And they all feel like these opportunities are going to last for some time to come. Now, Apollo Investments also done a few smart things lately. They opened an energy lending office in Houston to take advantage of the fracking explosion in the natural gas industry and lend to some of those companies that don't necessarily have access to the public markets. And these guys are pretty smart because they know that high yield spreads have come way in, and risky assets have appreciated tremendously over the last couple of years. So they're really reshaping their portfolio. They're getting rid of some of the riskier loans that are further down in the capitalization of these companies. They're taking a little bit of a hit to income because they're really focusing only on senior secured debt, where they're still getting a good interest rate, but if everything goes wrong, there's a pretty good chance that they're going to get most, if not all, of their money back. So very smart guys. They are a business development company, so a lot of our return from this one is going to come in the form of dividends. This stock actually yields over 9% right now. That's going to go up as the economy continues to improve. So if share prices just double over the next 5 years along with that dividend, you've got a compound total return approaching 30% on your money. So again, just common sense. The stocks are down. They're down for a reason. We've uncovered the reason. We want to know now, why will they necessarily go up? We've identified some solid reasons that can drive these stocks a lot higher, and there's a margin of safety in the balance sheet. That's where the value investor in me comes in. The balance sheets are solid enough that these guys are going to be able to survive long enough to thrive and possibly double, triple, or more the stock price over that 3 to 5 year market cycle. So the math of long shots and turnarounds is incredibly compelling, especially for younger, more aggressive investors. I really think more of your portfolio should be dedicated to this type of investment opportunity.